JP Morgan just flipped long on silver. Not a minor repositioning, not a tactical hedge, a structural reversal of one of the most heavily manipulated trades in modern commodity history. And if you understand what that means, not just the headline, but the actual mechanical implications of this move, you're watching the early stages of a price dislocation that could redefine precious metals positioning for the next decade. If this breakdown is hitting the way it should, do me a favor and smash that like button. Subscribe if you're not already here. This kind of structural analysis doesn't show up in mainstream coverage, and you need to be plugged in when these shifts happen. Here's what most people miss. JP Morgan isn't some rogue bank making speculative bets. They are the dominant market maker in silver futures. They have been the structural short in this market for over a decade. Their short positions have been so large, so persistent, and so mechanically embedded in the COMEX futures architecture that they functionally set the ceiling on silver prices during multiple rallies. When JP Morgan is short, silver doesn't break out. When JP Morgan covers, silver consolidates. And when JP Morgan flips long, which is what just happened, the entire suppression mechanism that has kept this market capped begins to disintegrate. This isn't speculation. This is observable in the CFTC commitment of traders' data. As of mid-December 2025, JP Morgan's net positioning in silver futures has moved decisively long for the first time in years. Not a minor shift, a full structural flip. And the implications of that single move are so profound that if you don't understand the mechanics behind it, you're going to be completely blindsided by what happens next. Let me explain exactly what silver manipulation is at a structural level, because this isn't some conspiracy theory cooked up by gold bugs on Reddit. It's a documented, mechanically verifiable suppression mechanism that operates through futures market dominance. Here's how it works. Silver trades on two planes. Physical silver, the actual metal, trades in a market constrained by mining output, industrial demand, and investment flows. But the price of silver is not set in the physical market. It's set in the futures market, specifically on the COMEX, where paper contracts representing future delivery of silver trade at volumes that dwarf actual physical supply. On any given month, the notional silver represented in COMEX futures can be 50 times the amount of physical silver that actually exists in deliverable form. Now here's the key. If you are a large commercial bank with deep capital reserves and access to cheap funding, you can short silver futures in size without ever worrying about physical delivery. You simply roll your contracts forward every month, maintain your short position, and every time silver tries to rally, you dump more paper contracts into the market to suppress the price. You're not selling physical silver. You're selling the promise of future silver. And because futures prices lead physical prices, because derivatives set the marginal price in financialized commodity markets, your short position in paper silver directly suppresses the price of the actual metal. This is the game JP Morgan has been playing for over a decade. Massive, persistent short positions in silver futures that act as a mechanical ceiling on price. And it worked because they had the capital to sustain the position, the market-making infrastructure to control order flow, and the regulatory blessing to operate without meaningful position limits. But here's what nobody told you. While JP Morgan was shorting paper silver, they were simultaneously accumulating physical silver. Hundreds of millions of ounces. Quietly, steadily, over years, they shorted the futures to suppress the price, then used that suppressed price to accumulate the physical metal at artificially low levels. It's one of the most brilliant and ruthless trades in modern financial history. And now that they've flipped long in the futures market, the suppression mechanism is gone. So what happens when the dominant short in a manipulated market flips long? You get a mechanical squeeze. And that's where things get dangerous. Let's walk through the causation here. Because this is not a straight line move. This is a multi-layered structural shift driven by three converging forces that are all accelerating right now. First, the physical supply-demand imbalance in silver has reached a point where it can no longer be papered over by futures market manipulation. Silver is not just a monetary metal, it's an industrial metal with irreplaceable applications in solar panels, electric vehicles, electronics, and grid infrastructure. Global silver demand has been running a structural deficit for 3 consecutive years. That means the world is consuming more silver than it mines, and that deficit is widening. In 2024, the global silver market ran a deficit of over 180 million ounces. In 2025, that deficit is projected to exceed 200 million ounces. And this isn't a temporary spike. This is a structural trend driven by the energy transition, which requires silver in quantities that simply cannot be met by current mining output. Every solar panel requires roughly 20 grams of silver. Every electric vehicle requires another 25 to 50 grams. And as electrification accelerates globally, silver consumption is on an exponential curve while mining supply is flat to declining. Now here's the part that matters. When you run a structural deficit in a commodity market, inventories draw down. And when inventories draw down far enough, the futures market loses its ability to suppress price because there's not enough physical metal left to deliver against contracts. COMEX silver inventories have been falling steadily throughout 2025. Registered silver, the portion available for delivery, is now below 50 million ounces. That's a tiny fraction of the open interest in silver futures. If even a small percentage of futures holders stand for delivery, the exchange faces a crisis. JP Morgan knows this. They've watched inventories drain. They've seen industrial demand accelerate, and they've recognized that the physical shortage is now so severe that continuing to short paper silver is no longer profitable. In fact, it's dangerous because if COMEX inventories fall low enough, a delivery squeeze becomes inevitable. And when that happens, anyone holding a short position gets obliterated. So they flipped, not out of altruism, not because they suddenly believe in sound money, but because the structural trade has reversed. Shorting silver made sense when inventories were ample and industrial demand was stable. Shorting silver is suicide when inventories are critically low and demand is spiking. Second, central bank policy has created a monetary environment where hard assets are the only rational hedge against currency debasement. And silver, because it's undervalued relative to gold and underowned relative to its industrial utility, is positioned to absorb a disproportionate share of that flow. Look at what central banks have done over the past 5 years. The Federal Reserve expanded its balance sheet by over $4 trillion during the pandemic. The European Central Bank is still running negative real rates even as inflation persists. The Bank of Japan is trapped in yield curve control with debt to GDP above 260%. Every major central bank is structurally committed to inflation because the alternative, allowing real rates to rise and debt to deflate, would collapse the financial system. This is not a policy choice. This is a policy trap. Governments and corporations across the developed world are sitting on debt loads that are only serviceable at artificially suppressed interest rates. If central banks tighten too much, defaults cascade. If they ease, currencies debase. They've chosen debasement. And once you understand that, you understand why hard assets are not a speculative trade, they're a structural necessity. Gold has already absorbed a significant portion of this realization. Central banks have been net buyers of gold for 15 consecutive years. Gold is up over 30% in 2025 alone, but silver has lagged. The gold to silver ratio, which historically averages around 60 to 1, is currently sitting near 90 to 1. That means silver is dramatically undervalued relative to gold. And when monetary debasement accelerates, silver doesn't just catch up to gold, it outperforms, because silver has the dual tailwinds of monetary demand and industrial demand while gold is purely monetary. JP Morgan has read the macro map. They know currency debasement is structural, not cyclical. They know hard assets are going to reprice violently higher over the next decade. And they know silver, because it's undervalued and underaccumulated, offers asymmetric upside that gold no longer does at current prices. Third, the regulatory and political environment around commodity market manipulation is shifting, and that shift is removing the structural protections that allowed JP Morgan to suppress silver for so long without consequence. For years, JP Morgan operated in a regulatory gray zone. Yes, they paid fines. In 2020, they settled with the DOJ for nearly $1 billion over spoofing and market manipulation charges. But those fines were a cost of doing business. They didn't change the underlying structure of the market, they didn't impose meaningful position limits, and they didn't force JP Morgan to unwind their trade. But that's changing. There is growing political and institutional pressure to reform commodity futures markets, particularly around position limits and the role of non-commercial participants in price setting. The CFTC has been under scrutiny for its failure to enforce meaningful position limits in precious metals. And while regulatory change moves slowly, the direction is clear. The era of unlimited paper shorting in commodity markets is coming to an end. JP Morgan sees the writing on the wall. If position limits are imposed, their ability to suppress silver through futures dominance disappears. If enforcement tightens, the legal and reputational risks of continuing the manipulation trade escalate. So they're exiting before they're forced to exit, and in doing so, they're front-running the very regulatory shift that would have eventually compelled them to cover. Now let's project this forward, because understanding the causation is only half the battle. You need to see where this goes. JP Morgan flipping long doesn't just remove the suppression mechanism, it actively reverses it. Because now, instead of dumping paper contracts to suppress rallies, JP Morgan is positioned to benefit from rallies. And given their market-making dominance, they have the ability to amplify those rallies by managing order flow in a way that accelerates upside momentum. Here's what that looks like in practice. Silver breaks above a technical resistance level. Momentum traders and systematic funds start buying. Retail investors see the breakout and pile in. And instead of stepping in front of that rally with massive short sales, which is what JP Morgan used to do, they now step aside or even add to their long position. The result is a price move that overshoots to the upside instead of getting capped. And once silver breaks above a certain threshold, let's call it $35 an ounce, which is the 2011 high, you trigger a psychological shift in the market. Investors who have been burned by silver for over a decade start to believe the breakout is real. Institutional allocators who have ignored silver because it was range-bound start adding exposure. And industrial users who have been operating on just-in-time inventory management start panic buying to secure supply. That's when the squeeze accelerates. Because at that point, you're not just dealing with speculative flows, you're dealing with physical offtake driven by genuine supply shortages. And when physical demand overwhelms paper supply, futures markets break, prices gap, delivery failures become a real possibility, and anyone still short gets destroyed. The mainstream narrative right now is that silver is just another commodity bouncing on industrial demand optimism. That's wrong. Silver is entering a structural repricing event driven by the convergence of monetary debasement, industrial electrification, inventory depletion, and the removal of the single largest suppression force in the market. JP Morgan flipping long is not the cause of this move. It's the signal that the structural shift is already underway. And here's the final piece that ties it all together. JP Morgan doesn't flip long unless they believe the upside is measured in multiples, not percentages. This is not a trade. This is a positioning shift for a decade-long move. They accumulated hundreds of millions of ounces of physical silver while suppressing the price. They are now positioned long in futures while sitting on a physical hoard that will explode in value as the market reprices. This is one of the most asymmetric setups in modern commodity history, and it's unfolding right now. So what does this mean for you? It means the game has changed. Silver is no longer a suppressed asset waiting for a breakout. It's a structurally mispriced hard asset in the early stages of a violent repricing cycle. The manipulation isn't ending because regulators stepped in or because justice prevailed. It's ending because the manipulator flipped sides. And when the biggest player in the market reverses course, the entire structure collapses. If you've been waiting for confirmation that silver's time has come, this is it. Not because I'm telling you, because JP Morgan just showed you, and they don't make moves like this unless the math is undeniable.